Hey, Cale, welcome to the show. I appreciate you being here.
Yeah, thanks for having me, Lacey. Honored to be here.
I'm excited to have this conversation with you. In my preparation, I was reading your bio and I got curious about something about what you do. So I thought it would be a great question to start with is that you are a portfolio manager and for an ETF, and I wanted to know, what is that and what does a day in the life look like for a portfolio manager? Because it's not just like saying what you do, but what does a day to day look like?
Yeah, sure. I guess the somewhat abbreviated version is my day to day is really spent keeping tabs on the specific companies and stocks that we own in that portfolio. And the context is, yeah, it was about 3 months ago. After a lot of work and help, we launched our own actively managed energy ETF. My background prior to starting this firm a number of years ago was on the research analyst side, and energy sort of became a specialty over the years. So in that portfolio, which is now an actively managed ETF that anybody can invest in, we're really focused on energy companies. That's both kind of traditional oil companies, natural gas companies, as well as more modern companies. We take in all of the above approach to energy. My day is really defined by what's going on in commodities markets, what's going on at the specific companies that we own in the ETF. And most days there's not a lot of new activity to do other than to monitor. There will be times where we need to make a change and we want to really make sure that we're doing good valuation work. And our whole approach is really based on getting a Warren Buffett type understanding of each of the companies that we invest in and want to own them long term and really figure out what makes them tick. Probably a shorter version, a shorter, more glamorous version of the reality, which is I feel like I'm reading constantly all day long about lots of different subjects in the energy space, which these days also includes electricity. With AI and data centers, that's becoming a bigger theme. Reading a ton is the short version.
That's what I was going to say. It sounds like a lot of research, and research is reading.
Exactly. Yes. Yeah. And energy, it's neat as a sector. It's very time intensive. Really any minute of the day you can find, for instance, what is the price of WTI? What are oil prices doing this moment? And that has a very direct impact on what the valuation of the companies that we own could be. I joke around with some of my peers who run tech stock portfolios where Facebook reports once a quarter, and every other day in between. I'm not sure what those guys do all day long, but energy is particularly intensive. But it's a good match and a lot to like about it. Just where I gravitated to over the past few decades, I suppose.
I find it fascinating that you brought up the infrastructure energy for AI. That is on everybody's mind. That's what everybody's talking about. And I was actually recently talking to somebody I know, and they're very interested in getting into stocks that are around AI, like the energy stuff, because realizing that is going to take a lot of these centers. So whether that's building that or having the power to run those centers.
Yeah, absolutely. Yeah, there's a ton of attention on the sector right now. It's a little bit of a convenient thing, I guess, in terms of my own skill sets. Used to do a lot with oil and natural gas production companies. For the last 10 years, I've been on a board of an electric utility, so feel like really have built that skill set. And to see both those worlds kind of coming together in this ETF is really pretty neat. There's going to be, and there already has been, a ton of money to be made, to be crude about it, in AI in general. But there's going to be a lot of shirts that get lost along the way too. There's a ton of hype. There's a ton of, borderline irrational exuberance. I'm not sure how many of listeners remember back in 1999 with the telecom.com bubble. I don't think we're at that stage yet. This feels a little bit more like 1997 than 1999 in terms of how overexcited people are. But the point is that there are some strong, I think long-term fundamental trends powering that AI push that really intersect well with energy companies, particularly utilities, natural gas. That's really going to be a huge source of the power generation that a lot of those data center needs. So yeah, it's kind of like to say we planned it perfectly and launched this ETF at the exact right moment where all these trends intersected and did not. We got a little bit lucky there, I suppose, but we'll take it. We've got a lot of opportunity in front of us and some real risks to navigate too. So I think we can hopefully add some value for folks.
When you're looking at investments, you're looking at companies, you're doing all of this research. When I think about business, or what I've been told and what I've lived through, there's a point where it's a lot of people start a business, and I feel like with all the things that go with AI, like a lot of people trying to, like you said, like jump in this, get in it. How do you decide what is a good investment? Are you looking at longevity? But then how do you balance that with being on the cutting edge? You do need something that's new and hasn't been proven yet. So just curious, how do you make that decision? Because to me, that would be very scary.
Yeah, it is too. And this could easily be its whole separate podcast, Lacey. And I'll try not to get too much in the weeds because I love this stuff and can talk about it all day long. I guess at the highest level, right, whether an investor realizes it or not, the stock market is going to force you to kind of pick a code, like pick a framework for how you approach the market. Because if you don't, then it usually is not going to necessarily end well. So, the market can be thrilling and amazing and all the best of free market capitalism, but at the same time, it can also be wild and have no conscience and at times be violent too. So, I think if you start with that framework in mind, which I think is just an objective, invest accordingly, and then the question becomes, all right, well, what sort of framework, what sort of code am I, as a person going to try to have and insist on in the sorts of companies that we want to invest in? For me, it ended up in, this is where it probably gets a little bit long-winded. I ended up, 25 years ago, I guess, really kind of lobbing on to that philosophy of Warren Buffett and really emphasizing free cash flow and really paying a good price for a company and doing the valuation work. There are lots of ways to make money in the market, but I think everybody's got to find their own personal approach. And I think it's probably also important that approach you take, just kind of mirror your own personal codes. And frankly, I think there's a lot of that comes with, military service too, and a lot of those same attributes. Like we put a lot of emphasis on the management teams of the companies that we want to invest in, and all right, are they same thing you'd look for in a good service member? Do they have energy, intellect, and intelligence, and those sorts of things? So I think there's a lot that I feel like I can take from my own background as a veteran and really apply that lens to management teams and really help figure out, the right way to view these things in a way that's consistent with our own long-term goals and what my own sort of personal beliefs are on how you can navigate the world and what can be in certain times. So hopefully there's somewhere's an answer for you, but that's kind of at a very high level how I'd probably start to think about it.
Yeah, absolutely. You must have been reading my mind, because I was thinking to ask you next your thoughts on leadership. I see, for me, working with people, I was just having this conversation, kind of coaching some people on podcasting and business, and talking about the people you work with. I feel like as a veteran, even more so. I mean, I think military spouses are the same way, but whoever's leading that is important, because the success of it depends on that leader. So I think that's interesting that you brought that up, that you are looking heavy at that, because when I look at any partnership that I'm doing or trying to work with people, that is important to know, like, you're betting on a horse, and can this person go the distance, stay in shape, be good to work with? All of these things play into it. And when you're picking a stock, if people thought about that way, really, like, would you hitch your wagon to this guy, this person, this lady, this guy that's in charge? Same thing applies, I think, to what you're investing in.
It does for sure in two ways. And yeah, to your point specifically, I think it's probably the most important factor. What is the caliber and character and leadership style of that management team of this company that we hopefully, buy on day one and still own 10 years later? We're really specifically looking for, capital allocation skills. But you don't have, as a CEO of a publicly traded company, you don't have good capital allocation skills in a vacuum. It also means you've got to, be a good leader and set an example from top to bottom in that company. So it is also the hardest to quantify, frankly. If you're, every good CEO of a publicly traded company is also probably a bit of a salesperson. So you can call them and ask them all sorts of questions about the business, which is probably recommended and good, but you've also got to asterisk all those answers a little bit because you're getting a little bit of the sales pitch. So I think it's easier maybe to spot good principled leadership among that management team sometimes about how they don't answer those questions or how they might treat their own staff. So yeah, undeniably that's a huge portion. It's the hardest part to quantify it as an analyst too. What is the character of this team that's leading this company? And then even as a portfolio manager on the other side of it too, we've had that discussion internally here, and we're veteran heavy group here. There are a lot of times where being a portfolio manager is an exercise in leadership, not necessarily in the analysis we're doing on the companies that we own, but in explaining why to our investors. And the market may dive for one way, shape, or form, and then that's not necessarily a company selection issue. That's a reminder. We want to lead this investor base we have through whatever whether it's the tariff tantrum or COVID. There's a lot of portfolio management is also an exercise in leadership too, and in a different lens as well. So probably underscoring too much what you already said, but yes, it's absolutely a critical part of how we select companies and how we try to run this ETF as well.
It's an important point to really drive home. So I what you said I think is great, because for service members, veterans, and military spouses that we can relate to understand in investing, that because a lot of people have been under poor leadership. And so they understand, yes, especially in combat, in training, all of these things. I remember one time I had a leader and I was like, it was a huge, huge exercise. And I thought, man, we're all dead. Like, if this was real, like this wouldn't end really well. And it's just like, I was young at that point, but I realized like this isn't good leadership. Now, for whatever reasons, it happened the way it did. But then being under good leadership and be like, man, we could do anything. And so if you're looking at somebody that's running a company that you're investing in for long term, I think most military people, when they think about that how important it is in that framework, comparing their military experience to investing, I do think leadership is really important. So completely agree.
Absolutely, yes. Yeah. A whole other subject. We could talk for hours about it. Yes.
Yeah. I'll have to have you back on just to dig deeper in that. But I was going to ask, how did you go? You were in the Coast Guard. How did you go from Coast Guard to portfolio manager? That's different.
Yeah, boy. So I went to Coast Guard Academy. I was a management major there. My dad was also a big service family. Both my dad did 30 years in the Coast Guard, and both my grandfathers were Navy veterans, World War II. Uncle Mike, Purple Heart Marine in Vietnam. So the idea of service, I always wanted to do that eventually at some point, and I was fortunate enough to go to the Coast Guard Academy. But also, having grown up in that military family, I knew that it could be hard on the family too, because I was that kid. My sister and I moving every 3 years, and so I went to the academy and did my 5 years after. But at some level, I guess I always knew that it wasn't going to be a career for me. I just knew that before I started my own family, I think I wanted to have one hometown, and I guess where I'm going with this is it wasn't necessarily a straight path. It wasn't like I was sitting in class at the academy and said, someday I want to be a portfolio manager. It was just kind of following these little breadcrumbs and really following what I thought I wanted to do. before I got out of the service as a lieutenant, as an O3, I went to business school at night. I was stationed in Yorktown, Virginia at that time. Went to William & Mary, got my MBA, and it was during the finance class at William & Mary where an academics approach investing in finance in a very specific, efficient market theory kind of way. So I would sit in these classes, then I'd go to Barnes & Noble on the weekend and see, this guy Warren Buffett on the cover of Business Week. And everything that Buffett guy did was exactly contra to what, my professors were doing at business school. And at some point I just decided, Buffett was worth, I don't know, $25 billion at the time. And, I could see the old Toyota Corolla that my econ professor was driving. And I thought, I think I'm going to maybe listen a little bit more to the Buffett guy. So that was where the seed kind of started. But it was not easy to kind of make my way to this path. Still, I had to take a couple of other jobs and sort of, hop from a job in telecom to eventually becoming a telecom analyst at a little hedge fund. And it was not at all a traditional route, but I wouldn't change it for the world. It ended up working out just fine and not traditional in any way, though. So, yeah, it was just kind of marrying that core. I guess I've always been pretty analytical. I was never, and I think this is true of all the veterans I've ever met too. We're not really money motivated, compared to Wall Street. There's people go into this path for many different reasons, but it was never a motivation about money for me personally. It was really more just being part of a good team. And frankly, once you can make the transition from, all right, taking it out of the framework of how are we going to make money by investing in this, it becomes more about problem solving. How are we going to find out what this company is really worth? And let's compare it to what the stock market thinks it's worth. And then sometimes if there's a big gap, there's an opportunity to close. And if our friends and family, if they do well, if they make money along the way, then fantastic. That's win-win for everybody.
Yes. I'm going off all of my questions here. I just realized these are things that that I'm truly curious about on what you're saying. But I started my own business, started a conference, and people often say like, "Oh my gosh, like I can't believe you did that. You started an event," and like impressed by that, but they think it's a big undertaking. But you started an ETF. I think that is a massive undertaking and very scary. Like, what made you want to do that? And then also, I can imagine there's a lot that goes into doing that. How did you basically dive in? Like, what are the first 3 things that you did, and how did you not get overwhelmed by the entire process?
Yeah,
that's a lot of questions right there, Cale. I'm sorry.
No worries. The first step is to run your own in-house portfolio for about 15 years until you figure out what you're really good at, and then go from there. So the reason that we end up launching the ETF is it was better for our clients. I started the predecessor firm to Bastion was my own firm, Isla Morada Investment Management. I started that in 2008. Really focused on the idea of building the firm around a single portfolio that I would spend most of my time on. We were lucky enough to be really pretty successful over time in that portfolio. And then eventually we were using primarily model portfolios, so almost a separately managed account approach to the world. The short version of which, anytime we would sell, because our clients own that same stock in the same proportion in their own account, we would create a taxable event for them. So it's both good and bad. All right, great. We can grow this money, and it's nice that, they are able to pay the taxes with the gains that we create for them, but it still wasn't super efficient on the tax front. So it was just eventually kind of thinking long and hard enough and getting, the size of our asset base to scale enough that it was, going to be large enough when we launched the ETF that it didn't put us in any financial risk because the fees would be covered internally. It just made sense for our client's sake, to convert our in-house model portfolio strategy to something much more tax efficient. Then the ETF became the natural extension of that. And we, to fast forward through about 18 months of pretty intense work and filing and all that, we were also very lucky. Another veteran, Whisk Gray, Marine Corps, he runs a firm. It's called ETF Architect. He and another Marine Corps buddy of his, they have built a firm around the idea of helping independent advisors launch their own ETF. So they do a ton of the back end stuff. We work with them, and 16 years later, I guess this thing is finally an ETF that anybody in the world can invest in, which is kind of neat and exciting. But yeah, a lot of very specific domain expertise. We rely on Wes and the guys at ETF Architect to help us on the back end stuff. But the core portfolio management and valuation work and all the stock selection, that's here, and that part stays here. So you're right, it was a big jump, but we were able to think it through. We had really good help with Wes and his team, and our team here is phenomenal. So it was just something we felt like we could really make a difference and put this in front of a lot of folks who might be interested and do some neat things with it.
So there was a lot of experience before you ever really dove into that. But I love, shows what a great leader you are, Cale, that thinking about your people, like how they're making money, we're doing good by them, but they are getting taxed, and there might be a better way to do this, and doing what you're already doing. But eventually, it helps your people more by the way you did it. But that's a massive undertaking, so I could see that was scary. Was there any challenges when you started this that you're like, this might be the end of the idea, but you still overcame it?
Not so much with the ETF launching with Bastion specifically, but when I launched my predecessor firm, Isla Morada Investment Management, that was back in 2008, and I launched, kind of knew when those, I don't know how much you remember, but in late 2007, those two Bear Stearns hedge fund collapsed. I felt like I was kind of keeping an eye, and I was an analyst at another firm, so I was keeping an eye on broader macro stuff, and kind of thought, 08, 09, it could end up being a really neat time to launch my own fund finally, because maybe there'd be some really compelling values. Never predicted it would go as sideways as it did, but the point is, I started IIM, as we call it, in middle of 2008. We just had our second daughter, left a great job before, and my original thesis proved correct in that, we had phenomenal first-year returns. Our first year, Lacey, we were up 92% our first year, but nobody cared because the rest of the world was falling apart. So it really, it was about 3 years until I could draw a salary from the business, just even though it was the right time to start, even though the fund as it was back then had a great, beginning, it didn't matter. It didn't matter. And so that part was really all right, let's put our business person hat on and really think more about, how are we going to build process to this, and how are we going to, really build a firm here, rather than just hope that when you put up great numbers, the world would be at a path to your door, because it did not. And that took a little bit more effort to overcome than I thought originally. So I think most small business people have that, that valley, and you're like, all right, there's some more challenges here than anticipated, and absolutely had those, and then some early on for sure.
Yes, I think starting a business like having kids, like if you knew all that went into it, you might not do it.
Exactly. Yes. Yes. And all the other former parents or other small business owners see you doing it, and you can tell they're holding back, but you're not sure why. And right.
Right. Yes, it's like, but that goes back to what we were talking about earlier in AI. People wanting to move quickly, and this is new, it's cutting edge, but most businesses fail between 3 and 5 years. Like, they're not making it past 3 or 5 years. And so thinking of somebody that's just starting out, an AI company that's supporting, this industry, yes, they might be onto something, but like, can you go the distance? And so that to me is scary about investing. I guess that's, why you would get a higher return, probably because you are taking a lot more risk.
You are, yeah, for sure. And I think it also speaks to just, as the owner of that small business, and you read the stats and you just realize, all right, just the sheer sort of arrogant act of starting your own business, like the odds are against you, just statistically speaking, right? But I do think, that prior military service, one of the many things I think the military is good at is teaching you how to work hard and make good decisions even when you're exhausted. And if that doesn't define, the small business owner's mentality, then I'm not sure anything does. And that was absolutely something that, I attribute our success to a lot of things beyond my control, and that's probably one of them too. Just being able to grind it out when you had, and that part never changes, by the way. It's 17 years later, and and still up all night doing stuff. But the difference is, you love it, and it's like a child, and it's neat to be able to have that influence over the company for sure.
Yes, absolutely. I also agree. I agree with everything you said there too about people that have served, but also often you're thrown a problem that you have no experience in, and I think that's what I have found about myself in business. Is like, this is a problem, but I have figured out just problems I am not familiar with at all in the past. And like, okay, well, I've done good in all of these different areas that. Yeah. Probably if most people are like, why did you do that odd job? Why did you, do this? People, the voting officer on active duty, people that, all of a sudden now are thrown in events, but, they are, in the infantry or whatever it is. So they have these skill set to like adapt and overcome from any situation that's been thrown at them. I feel like that's is like you have a history of figuring it out.
And I think you hit the nail on the head there too. It's not necessarily just the ability to solve problems, but the ability to solve problems that you would not choose to solve. I mean, things get thrown at you, and any rational person would say, I just don't want to have to deal with this particular thing. But that's right out of the military. You don't get to weigh it. You don't get to predict the sorts of problems that you're going to experience. You just have to solve everything that comes at you, and that's also, part and parcel of being a small business owner for sure.
Yeah, there should be like a weekly meetup where it's like, let me show you my problem, and we'll switch if you're okay with taking this one on. I think nobody would switch. Nobody would switch. So, well, I know I got the cart before the horse, but I do want to ask you so you can kind of explain people that aren't familiar with it. You are the portfolio manager for an ETF that focuses on energy. What is an ETF, and how is that different from a mutual fund, and where does index fund go in there? Because these are all terminology that people hear all of the time. Because now, the TSP, what is that? They now have mutual funds, but they also have index funds.
Yeah, for sure. I guess I would say that an ETF, which stands for Exchange Traded Fund, it's the more modern version of a mutual fund. It's more modern in probably two primary ways. The first is that, and neither of these are necessarily obvious to folks, so I'm glad you asked. The first way is that you can buy shares in an ETF anytime the market is open, which gives it a lot more utility to different kinds of investors. Mutual funds, people don't necessarily realize, but technically, you can't really buy a unit or share of mutual fund until after the market's closed, which has a lot to do with accounting and how the fund is structured. The probably more advantageous reason to consider an ETF, however, is just because it's much more tax efficient. The what they call the creation redemption process when it comes time for new investors in an ETF to buy into that ETF, it's just fundamentally done differently in a way that's much more tax friendly to end investors. A lot of mutual fund investors may know this problem with mutual funds is that you can own a mutual fund, and let's say it went down last year. So your money in the mutual fund you own decreased in value last year, but this year you still have to pay taxes on that fund because of the way the fund distributes its losses and gains. So first of all, to see your money decline and then have to pay taxes on it because some other investors sold their interest in that mutual fund, it just seems fundamentally unfair, and I suppose it is. ETF solves all those problems. So it's very, it's much more liquid. But the big, I think, driver, I think the big reason that we've seen as an industry so much growth in ETFs specifically is because they're just much more tax efficient for the end investor, which is a great sort of modern way to approach the world. To your other question about index funds specifically, there are, as you've seen, mutual funds that were index funds become ETFs. We're now seeing actively managed funds, which is more what I do, become ETFs specifically. So let me back up. You can buy an index fund that is an index mutual fund, or you can buy an indexed fund that's really an index ETF. If you were to compare both those, say that the Vanguard S&P mutual fund versus the Vanguard S&P ETF, what you'll see is that the ETF fees are even lower than the already low fees on the Vanguard fund. So if the framework in your head is that ETFs are just the more modern mutual fund, that may explain why you're starting to see even more index funds become ETFs. It's just the structure. Nothing inside has really changed. It's just the structure of that fund. It's got more tax efficient, and good firms like Vanguard, lower the fees even more because of that. So you can still have index funds that are mutual funds or index ETFs, but that would be my advice to listeners: is look at the index ETF options first, because they're going to be a little more tax efficient and probably a little bit lower fee than index funds that might be mutual funds, if that makes sense.
Yes. Would you say index funds are more passively managed than the mutual funds?
Yes, for sure. Yeah, that's a good point too. So in that distinction, that's another distinction between sort of mutual funds and ETFs. The other big distinction that you hear a lot about these days is just that. It's the difference between passive funds and active funds. You can have passive and active mutual funds. You can have passive and active ETFs. What our little energy fund, though, is an actively managed energy ETF. So kind of combining, I guess, both the sort of the newest versions of both of those. Another longer discussion we can have about pros and cons. I would just, I guess at this point, say for most 90% of all investors are probably just better served with a passively managed S&P 500 index fund, probably an ETF. Most people, the vast majority of people, would be better off just putting their money in that S&P 500 index fund, and Vanguard's got great options, as opposed to an actively managed fund. That said, and the reason that I guess I am a bit of an apologist on the actively managed fund side is because I do think with the right framework, that sort of Warren Buffett value investing framework, there's times when you can really outperform the market. And then, broadly speaking, those S&P 500 index funds are almost always the right place to invest money for most people, presuming that valuations are reasonable. And there's a whole other discussion we can have about, all right, are the valuations, would I want to be putting my money to work today where the market is valued as highly as it is? Maybe not. Separate discussion, and don't want to get too far down the weeds. But yes, so we take that actively managed, and by that I mean we're sort of curating and selecting both the stocks in the ETF as well as how much we want to weight each stock in that ETF. That is something that I alone determine as the manager of this fund. And in passive funds, it's sort of done by committee. But there are risks to that too that people don't necessarily understand, and can be a whole other discussion, like I said.
Yeah, I'm gonna have to pull out all these separate questions and have you back on. But
I've had too much coffee, so keep going.
But the first thing I asked you is what your day-to-day life looks like, and I think you described the active part there is all of the research and the homework that you are doing to stay current. Like you are paying somebody, the expert, to do that work for you versus you as the individual investor, like trying to understand AI and technology and how that plays into energy.
Exactly, for sure. There's this whole industry is so kind of rife with salesmanship and people who can really articulate things in a very smart sounding way, but that can also be different than actually, do they know how to value a company? Do they have a core philosophy that ties this all together? Are they really looking to do things for the long term, et cetera? So big distinction. typically people want to come with us. They want, for instance, exposure to, they think all right, I think there's going to be neat things coming down the pike, for instance, with nuclear stocks. And well, I can either just go buy a nuclear stock myself and kind of throw that dart and hope it works out, or you can, in theory, do that via an ETF, and in which case the conversation is from my side anyways, it's like, look, nuclear is going to be great longer term. I think SMRs are a fantastic way to think about it, but SMRs don't exist yet. There's literally none in existence, and instead of trying to buy overvalued stocks that might be very susceptible to a downturn when it comes, let's talk about one of our other portfolio, a good old-fashioned utility that happens to own 4 or 5 nuclear plants already inside it. And let's try to keep, the free cash flows paramount and that sort of thing. So, but I love it. That analysis is really kind of what I've been doing for a long time, and it's just another extension of that for sure.
You mentioned earlier, like for most investors, an index fund is that's where, none of this is investment advice. So I'll definitely put a
yes,
note
thank you. Yes, right.
a note in the show notes and in my intro. But would you say that the majority of people that maybe you deal, I'm trying not to ask like a personal business question, but like, would you say that a lot of the people that are your clients or that are looking maybe at that level of investment have more experience? Like they've built up they don't have any debt, they have a lot of money in investments, and so this might be something that's in addition to, like, maybe they might have an index fund, but they are trying to, for tax reasons, for other further financial planning reasons, they need to broaden their investments.
Yeah, for sure. So probably 2 questions there. The first is, our whole sort of fundamental value investing philosophy, it definitely sort of resonates more with small business owners, because if you've run your own small business, then all right, it's all about the cash that's in the register at the end of the day, and it's those same principles that we apply here to sort of stocks on a much grander scale. So that part is absolutely, I think, true and holds up. And then I think it's sorry, the second part of that question, Lacey, was I got distracted with it.
Is this maybe people that have more wealth built up that are more in ETFs and mutual funds?
Yes. Yes, exactly. Yeah. So in theory, one of the things we do with the firm is we are probably a little bit different in that we sort of advocate for that kind of core and explore approach, which is what we call it. So most people, even if they may have most of their portfolio with us in index funds, very low fee, they get the diversification, and then we'll add maybe this energy fund. A small wedge of their total portfolio might be this energy fund, because we can see that energy as a sector is very undervalued right now. So in theory, if you take the S&P 500 index fund and you add some energy, then in theory there might be a little bit of outperformance to gain over time versus just the S&P 500, and trying to do that in a very cost-conscious manner. So yes, we have. Now that said, we've got a number of folks who have come here just for whatever reason they recognize that, okay, this guy in the Keys maybe knows a little bit about energy. Let's just give him this amount of money and let him run with it. All the money we send is going to go in the energy strategy. But we've got many more clients who have said, we want you to sort of look after everything. We like what we're hearing you say about energy, but we don't want to put everything in that bucket, and that's fine too. We want to be flexible and let people use this as they see fit.
What are some of the biggest investing mistakes you see, military families make, and possibly how could they avoid that?
Yeah, I don't know that I'd specify or pin this one just on military folks, but I think it is very understated and applies to a lot of people. The biggest risk that Wall Street never talks about is really overvaluation risk. I mean, the amount of wealth that's been destroyed by people, and sort of draw your own conclusions about whether this is one of those moments or not. People buying stocks that are dramatically overvalued at just the wrong time. I think you can make the case whether it's housing in 2007 or .com stocks in 1999. If you're not really spending a lot of time in the industry, if you got a normal life and are out doing jobs or serving, or you're overseas, you're just not going to be able to track a lot of the valuation focused metrics. But I think that by far is the biggest sort of least talked about risk on Wall Street is buying things that are overvalued. And that's kind of how we sort of build our whole investment philosophy is let's make sure whatever we don't do that. And then everything else we can kind of fill in the gaps and outperform over time. I think in general, the other part that's maybe a little bit more specific to military folks is I think there's a certain, and I certainly felt this too growing up in a military family and serving and all that myself, like there's a certain level of implied trust that I think we probably have, definitely with each other, but that you presume that other people may have also. And in the financial services industry in particular, I think we as a group collectively, and most junior officers, junior enlisted, just being young is part of this, but you kind of get taken advantage of in many ways if you're not very careful about it. And it took a while to kind of figure that out. Fortunately, it wasn't stuff that happened with us, but just as a junior officer, with seeing the young guys just out of boot camp on the ship, and sure enough, they've been on the ship for 6 months, and the next thing you know, they're driving a Ford Raptor, and you don't have that kind of salary, that sort of stuff. So like those sorts of common mistakes that you look back at now and think, man, there was just a core level of kind of financial literacy missing. This was the 90s, and hopefully people these days are a little bit smarter about it. But it's something to factor in, no matter what. And I'm biased, right? But I feel like, going to a fiduciary, even if you don't know necessarily the backgrounds of the people that you're talking to about insurance or investing, or if they're at a fee-only firm or it's an RIA or they have legit fiduciary credentials, then you're starting out in a good spot already.
For people that aren't familiar, can you explain what fiduciary means? And when you put fee-only in front of that, like what does that mean?
Yeah, for sure. So fiduciary is someone who has both a moral and a legal obligation to put their client's interests first. The way that kind of manifests itself at a firm, a registered investment advisor firm, is really how we get paid. So the spectrum, take all of Wall Street, there's a wide spectrum of ways that people get paid. On one end, you've got sort of your big, your Morgan Stanleys of the world and maybe your Merrill Lynch's. And historically, those guys have gotten paid on a commission basis, i.e. by selling products. On the other end of the spectrum is where we are, and that's the independent fee-only RIA. The only way that we get paid is as a small percent of the assets that somebody decides to invest with us, or on an hourly basis for financial planning work we do. So those are the two ends of the spectrum. In the middle now, you're starting to see sort of hybrids. There's fee only, there's commission, and then there's a middle ground, what do they call it, fee-based, which is, all right, we're going to charge you some commissions for some things, and we're going to do hourly for others. And all right, that's better, I think, than just commission only. And nothing against the guys at Morgan Stanley and the people who work at Merrill Lynch. It's just a different model. And the question for clients is, all right, well, does it matter to me how these people get paid? And I feel like that being a fiduciary was just a better fit for my own sort of personal code and how I felt like we could kind of add some value, and people seems to resonate. I think those sort of fee-only RIAs, just as a share of the total financial advisor market the last 10 years, there's no question RIAs are seeing a huge boom, and a lot of it is because, there's a higher standard for the people that work there.
All right, that was going to be the last question, but I just actually want to ask you this. This is going to run a little longer. What are your thoughts on social media and financial advice? So I teach my kids, be careful of other people trying to get you to share their message. So I see that with like a lot of, just all these people at once starting to say the same thing is a red flag when it comes to stocks. And but especially the younger generation, it's quick tips. But what are your thoughts on, is that good for people? Like, it's bringing awareness, I guess, to investing, but it could also have a negative impact.
Yeah, great question. I'm going to reveal my bias, which I feel like, and I see this from both sides, both the having run an RIA for 17 years before, and that has its own compliance regime, And then now with the ETF, which is especially restrictive about what an ETF manager can say and not say on social media. I guess the short version, this is probably the dad in me coming out, is please do not pay any advice to anything you read on social media when it comes to finance. Full stop. That's a blanket statement. I'm almost certain that I'm doing some people a real disservice because there probably is some real good advice, but maybe I should soften that a little bit. If you're going to get financial advice from somebody on social media, this is probably the better way to frame it, Lacey. Make sure that person is a fiduciary. It's an odd industry in that me, the supposed expert and the licensed professional who's been doing this a long time, the compliance hurdles that I have to jump through to actually put out legitimate, sound advice on social media are so onerous that we just don't do it. And I think most RIAs, most portfolio managers are just like that. The problem, however, is bad behavior on social media when it comes to financial advice is a problem, but so is thinking that we ourselves are above that too. So somewhere there's a happy medium in there, and I guess modifying my own beliefs as we go here, I would say if you're going to pay attention to social media financial advice, if you really have to, just make sure it's coming from somebody who knows what they're talking about, who's a fiduciary or has some sort of professional credentials along the way. And I say that as somebody who for years took a lot of calls in from clients about crypto and Bitcoin and I because they were on Twitter, I think, seeing those things, and whole nother discussion, a whole nother old man get off my lawn element to it for sure. But hopefully there's some guidance in there.
Absolutely. No, I'm the same way. I've seen, especially with debt, that stuff online a lot of times upsets me because people are saying something quick about, getting out of debt or debt consolidation, all of these things, but they never mention tax consequences, yes. And so they're saying something, they're not saying the full story. And so there's so many, it depends. That is the start to every financial answer is it depends. It depends because that's not the person sitting in front of you that you are actually giving that like a client. So going on social media, I feel like that's, if you're going to listen to anybody, whatever they say, it should start with, it depends.
Yes, exactly. Depends. And it should be the first, if that's the thing that lights the fire, maybe somebody reads something on social media, which was equivalent to me in 1996, seeing the Business Week with Buffett on the cover. Maybe that's the discovery that launches it all, and who am I to short circuit that? But
that's a good point. Good point.
There's a lot out there for sure.
Yes. Okay. Well, I'm going to have to put a pin in all of this and get to some other questions. First, I ask everybody two quick random questions. One, what is a resource or tool that makes your life or your work easier?
Well, I'll tell you what, we internally, we are doing more and more with AI specifically on the analyst side. Started, using sort of ChatGPT, then Gemini really for kind of stock specific questions. At this stage, though, we can't really rely on those answers. There are new tools being developed. Really, the LLMs train on literally just all of the company's SEC filings. So that if you're using these finance-specific tools, we use one, for instance, called Tenzing Memo. It's phenomenal. I do worry about junior analysts. I feel like in a year, I'm not sure that those jobs really exist for guys like I was trying to get a foot in the industry 25 years ago. I'm not sure that junior analyst role, because even these very specific tools are getting so good, not perfect, but you can just see them getting faster. So I feel like a Luddite in many ways. I'm sure I'm only scratching the surface of what AI can do on the stock research side specifically, but I've been very impressed, and something that it's been, especially running your own ETF, it's a lot easier to track a lot of different things with good AI tools.
That's a good recommendation. What is your favorite book right now, or your favorite book of all time?
Oh, yeah. I'm a huge Cormac McCarthy fan. Like I've read all his stuff, sometimes more than once. Like I read the books about how he wrote the book. And I don't know first of all, I'm not a literature. I went to military academy, and I sort of raised by engineers. I sort of lack the I couldn't explain to you why I'm such a huge Cormac McCarthy fan, but it's just something that resonates. The problem when it comes to recommending any of Cormac's books is some of them are very dark. My favorite book of all time is probably Blood Meridian, but it's not one you could recommend to anybody because Indian Wars, and it gets very, very dark. So I guess I would say for a new wannabe Cormac reader, I would say like All the Pretty Horses. That would be a recommended start. There's it's a 3-book trilogy. It's fantastic. It's not very dark at all.
We'll link to that one, not the dark one.
Yes, not the dark stuff. It's great. I'm not sure why, but it just makes you think deep thoughts about, I guess, the world. So there's a whole canon of sort of value investor literature and books, I should say. Margin of Safety by Seth Klarman and The Intelligent Investor by Ben Graham. But that just kind of goes without saying, I think, for kind of somebody in this seat. It's more the, over time, find myself strangely drawn to a little bit more fiction, and Cormac's at the top of that list.
Well, I'm no expert, Cale, but I have a sneaking suspicion it's because you read about that stuff all day long. So fiction is probably the only time you can turn your mind off.
I think so. And it a symbolic. It's also, in many ways, I feel like the day-to-day of our job is really helping people make good financial decisions. But at a higher level, I feel like it's often, thematically almost the same, I guess, sort of thing that Cormac is addressing in his books, which is how do you help somebody build the code that is going to help them navigate a strange and sometimes unsettling world, and all that probably ties together at some level, but that's it involves a little too much self-reflection for me to figure out, I guess. Yeah.
Okay. All right. Well, I'll let you off the hook because it's time for game time, which is my favorite part of the podcast. And in honor of your visit today, we're going to play Plead the Fifth. So I don't pull out this game very often, Cale. So it's special for you. So I'm going to give you 3 questions on what you really think of something, and if you can answer them without pleading the fifth, you win game time. So, but if you don't want to answer it, you can plead the fifth.
It's a lot of pressure. I will try. Okay.
And this could be just short answers, like what your quick thoughts on it are. Okay, number 1.
Let's do it.
Do you think service members investing in crypto with no basic investing experience is a problem?
Yes. Did I win? Yes. Yes, it's a problem. Please don't do that.
Yes. Okay, good. All right, number 2. Do you think cashing out your TSP when you leave the military to put it into an annuity is a wise decision?
No. First of all, you forego the compounding benefits. Second of all, the commissions you're going to pay to that annuity salesman, if disclosed, would send you into an almost certain rage. Yes, please don't do that either. Yes.
I love that, into an almost certain rage. Yes, I think, I could say yes to that too. Okay, number 3. What do you really think about day trading?
Highly skeptical. I will say, however, that one of our younger fellas, he came here to invest in energy with us probably 10 years ago, I think this gentleman's probably the only truly successful day trader that I've ever known or met. And even though philosophically, day trading is the other end of the spectrum from long-term value investing, I do feel like there are unicorns out there that can do it successfully. For 99.9% of the people, if you're I'd leave it like that. If you're day trading and you're not a computer, you're an imbecile, frankly. Everything is so computerized these days, and all of those chart reading patterns and all of those technical indicators, I think they are easy to game for the serious algorithmic traders, and I would just be very cautious and skeptical about it. Don't take my sample size of one gentleman who was actually good at it to be an endorsement. I think even he would say, day trading is not for most people. It's gambling at the casino.
Yes. Okay. Well, that's great. Well, you win game time. You did not plead the fifth, so
All right.
you definitely have those bragging rights. I appreciate you playing the game and being on the show, Cale. Can you tell everybody listening where they can learn more about you and the work you're doing?
Sure. Yeah. Easiest way is lastbastion.com. Our bios, emails, the easiest way to reach out. I'm also on LinkedIn. I confess I don't do a ton on LinkedIn, and everything kind of goes through email. But lastbastion.com is probably the quickest, easy way to find us.
Wonderful. I will be sure to link to all of that in the show notes. Thank you again, Cale. I appreciate it.
Thank you. Yeah, it's fantastic. Appreciate it.